So we'll get started with the webinar today. So welcome all. Before we get into the webinar, I would like to take a few minutes to introduce Marmor. Marmor is actually a fully owned subsidiary of Marcus, Kuwait Financial Center. And at Marmor, we provide consulting and research services to clients across the GCC region. And our primary focus is on capital markets, banking, strategy, economic consulting, and also industry studies. At Marmor, we published more than 200 reports on various topics, and we are constantly in the vigor to serve our clients and help their businesses. So, as part of our ongoing webinar series, today I would like to share our insights on private credit as an asset class that has been gaining attention lately due to strong growth prospects and attractive returns. There has also been sizable traction in the market in terms of private credit, wherein there have been a lot of new fund launches in the past 2 3 years. However, private credit is a relatively new asset class. Uh, it's a relatively new asset class for a retail investor, but it has been prevalent and been accessible to institutional investment. Before we go into what private credit actually is, it's worth noting that why we are talking about private credit now. So private credit, which is generally an alternative investment category, has significantly outperformed traditional fixed income in the past couple of years. And even if you see the flows into private credit funds and the market size, there has been a significant upturn in the past 3 or 4 years, especially after COVID. And also, it is one of the fastest growing segments within the alternative investment space. And it currently has an AUM of 1.6 trillion as of March 2023, and it's much higher right now. And based on estimates from a lot of market players, the market is expected to touch around 2.3 to 2.5 billion by 2027, whereas some optimistic estimates are placing it around 3.5 trillion by 2027 or 2028. So, what has suddenly changed in terms of the private credit market is that there is much higher retail participation in from investors in the retail space. If you see the percentage of retail AUM in private credit funds, it was close to 2.3% in 2017. But right now it is close to 14.2% as per the latest estimates from PitchBook. So, what is driving this change? And before we go into that, what is private credit? Generally, when corporate borrowers want to borrow money, they have four broad ways of getting raising funds. And the method of raising funds generally depends on the company's size and credit worthiness. One of the most popular ways of raising funds is banks, and mostly bank lending is skewed towards smaller businesses and less risky borrowers. Another way of borrowing is syndicated loans, wherein banks do the lending, and after the origination of the loans, lenders decide to sell the loans to other investors, and these are tradable securities. Third would be the bond markets, which we are all well aware of, and mostly large companies tap the debt markets, bond markets for raising debt. And of course, they are tradable as well. So the final method is direct lending, which is otherwise known as private credit, wherein the loan is provided by a non-banking lender, typically an asset management company, by raising funds. And these funds are given to the companies, which are typically SMEs and non-investment grade. Due to their non-investment grade, they are not unable to tap the bond markets. Since due to these reasons, mainly they tend to go towards private credit. Mostly these debt agreements are agreed privately between the borrower and the lender, and they are generally not traded in the public markets. Returns are achieved by charging a floating rate spread over a reference rate, which is generally the policy rate. And there is a small premium over this policy rate. So, in terms of growth drivers, if we want to see what is spurring private credit, the growth of private credit, uh, after the global financial crisis, most banks have pulled out from lending to smaller companies. And if after the crisis, lending regulations have tightened significantly. What has happened is, due to this, lending has not the flow of funds is not streamlined towards smaller companies, and it mostly goes to larger corporates. And even if you see lately after the COVID crisis, recently the interest rates have been going up. So, and to an extent, the challenging interest rate environment has slowed down credit growth. But from the other sides, from a banking perspective, lending has also slowed down because banks are hesitant to lend to smaller corporations to preserve their asset quality. So, in the last few years, private credit has kicked off, where they have filled this void wherein bank which are typically done by where the lending is typically done by the banks. So considering these tightening lending standards and less favorable financial outlook, uh, a lot of companies have now tapped private credit, and in addition to these benefits, private going through the private credit gives a further advantage wherein the speed and certainty of the transactions are much simpler and easier compared to are much higher compared to a typical bank loan or tapping the debt markets. So this simplicity is also another this speed and certainty are another two factors that are spurring the private credit markets. So why is private credit preferred? So from a borrower perspective, like I said, the transaction speed is high, and it's also a much easier way for borrowers to get their funds. And also, this is not just the case for non-investment grade borrowers. Even high quality borrowers that may otherwise issue debt in the public market are slowly seeking financing from the private markets, attracted by this speed. And as an asset class, how private credit is more attractive to investors is that in current markets there are a lot of tailwinds, especially when you see in 2022. We all know that equities and bonds return negative income, but in the same time, negative returns. But at the same time, private credit was able to achieve very strong returns, and also with a very low volatility. Typically, the positive correlation between bonds and equity in 2022 spurred the growth of private credit. And also, in terms of statistics, if you see from 2015 to 2023, a portfolio that has a roughly 20% allocation to private credit has proven to reduce volatility, increase returns, and also add nearly 140 bips of income as well. So why do we need to look at private credit right now, especially considering that interest rates are already very high, and also we are moving towards a rate cutting cycle from next year. So when we look at recent events like the SVB crisis, banks have been very reluctant to lend to corporates. So, and especially the in the small and medium segment. So with slower bank and leverage loan growth, the demand for capital has increased from the private credit side. So if you see 2021, nearly 16%, 65% of the private, 65% of the loans for leveraged private market has been taken as private credit, and nearly 86% of the funds that fund these acquisitions are from the private markets in 2023. So even from an investor perspective, if you see, uh, in terms of the growth of private credit, there have been two distinct phases. One is 2020 to 2022, wherein investors were thirsty for yields. They the Typically an investor wants to generate alpha. So alpha in traditional asset classes were difficult because of the growth of passive investing. So when they needed to generate this alpha, the shift from traditional asset classes to alternate asset classes was starting. the shift had already started to happen. So, and also in addition to that, private credit within the alternative space offers a lot of defensive qualities, which is also a reason why it is being preferred. So moving on to the difference between private credit and private equity, the names might, at first glance, they might sound similar because they have private assets, private in their name. But only that is the only similarity between them, wherein they are private assets and they are not publicly traded. Uh, but the general perception is that both asset classes are very high risk asset classes, but that is not the case. The reason being risk is considerably low when you go into private credit compared to private equity. Private credit is something very similar to debt, whereas private equity is very similar to public equity. So in private credit funds, most of the direct lending private credit funds make senior secured loans to mid-sized companies, wherein they're first in line to get paid back in case of defaults, which is not the case in equities, wherein you take the ownership and there is a higher level of risk. And also, typical private credit funds, what they do is they consist of hundreds of loans. So they are within the fund, they are very well diversified as well. And since they are directly lending to the borrowers, and there is the transaction directly takes place between the lender and the borrower, they have much more visibility and in terms of the company's performance, cash flow, and even in their contracts, a lot of covenants are baked in, which makes them much more secure, despite them being private. Furthermore, when a company hits a snag, lenders can figure out a way to solve the problem by directly talking to the borrower, wherein they can add certain clauses and protections that either will give more protection to the lender or probably increase the rate of returns. And as a concept, direct lending isn't a very new concept. It has persisted through multiple economic cycles and multiple market cycles. So it's very similar to a traditional bank lending, but in this case, it is taken up by asset management companies who raise capital from investors. So in so these factors put private credit in the risk scale slightly above public debt, but the risk is much lower compared to public and private equity. So when we earlier had a look at the flows into private credit funds, we observed that there is a visible increase in the past couple of years. But how has the performance been on a risk-adjusted basis? So, considering direct lending, the performance of direct lending in the past 10 years, in relation to other debt instruments, their returns are visibly high compared to other categories such as high yield bonds, leveraged loans, investment grade credit, and also the US Treasury. And when you compare it to S&P 500, which is at the top right of the chart in the left side, uh, the returns are only slightly lower, but with much significantly lower volatility. So, since majority of private debt companies, majority of private debt is based on floating rates, they've been able to beat other traditional debt instruments. So, this is leading to a high return with very less volatility. So even when you look at some of the largest funds and their performance in the past 1 year, we see a median return of close to 9.9% in the trailing 12 months up to Q2 2023. So in terms of benefits offered to investors, there are three major benefits that private credit funds give. One is, as a credit investment, the asset class offers very predictable stream of cash flows through interest rates, which is typical for a credit instrument. And if you see in the decade to 2022, the private credit returns were nearly 3 to 6% higher than the returns that were achieved through syndicated loans and high yield bonds. So the second factor would be resilience. As lenders have deeper access to the company records of the borrower, it offers better scope for due diligence and documentation, since they are directly involved. And nearly 80% of the private loans recover from defaults compared to the 50% recovery rate in unsecured public corporate bonds. So another benefit that private credit gives to an investor is that the asset class typically has a very low correlation between stocks and bonds. Theoretically, if you see stocks and bonds, they need to have a negative correlation. But as witnessed in 2022, when bonds, we saw a drawdown in bonds as well. So private credit as an asset class provides that additional diversification. And within private credit, we also have different strategies apart from direct lending, such as distressed debt, which are counter-cyclical themselves, adding further diversification benefits. So when it comes to risks associated with private credit, as with all debt instruments, there is credit risks. There are credit risks. So borrowers who have weaker financial profiles, they are usually denied funding by traditional banks, and they are the ones who raise funds through private credits. So this is one risk that is persistent with private credit to a higher degree compared to public debt. And the underwriting standards are also not that tight as compared to traditional banks, which increases the risk exposure here. And in 2021, according to S&P Global, 33% of the private debt deals were found to be covenant light, wherein they did not have the necessary covenants to protect investors, which was much higher than the percentage in 2022, which amounted to 15%, which also increases the risk for an investor. Apart from credit risk, there is also interest rate sensitivity because the rate of return is based on floating rate. There is always the risk wherein the interest rate is dictated by the central bank. So apart from this, the default rate estimation is also a little difficult when it comes to private credit. Since things are not as transparent as public debt, there is a bit of opacity that comes into play here. And the estimated default rate for private credit in 2023, according to several sources, is in the ballpark range of 4.5%, which is much higher than the default rate of high yield market, which is close to 1.4%. As I said, direct lending, although is the most popular private credit strategy, there are other strategies within the private credit space that are offered in private credit funds. This includes distressed debt, wherein the debt of the underlying is the debt of companies that are in bankruptcy. So for investors that are high risk and need high reward, they generally tend to prefer distressed lending. Apart from that, we also have a mezzanine lending, wherein it consists of subordinated debt that is senior to equity, and in some cases there is also a clause wherein it can be converted into an equity position. There are also several special situation funds wherein the borrowing takes place to fund a merger or in some cases spin-off or even acquisitions. So venture strategy is tied to lending to early stage companies. Fund of funds strategy is a private credit fund strategy wherein a private credit fund has a lot of funds within their portfolio, and it becomes a fund of funds. The final strategy is a unitranche strategy, wherein a senior and subordinated debt are combined into one tranche. And moving on to the major players in the private credit market, most of them, as you see, are based out of the US. And the leading firm in terms of capital raised in the past, since January 2018 to 2023, has been Ares Management, which is a firm that is typically focused on alternative asset classes such as private credit, private equity. And apart from Ares, we have the usual suspects, which are Goldman Sachs, Blackstone, BlackRock, Oaktree, which are in the top 10 in terms of capital raised. So we are also seeing a similar trend that is percolating to the GCC region, wherein we are seeing a rapid growth in the introduction of private credit funds by local AMCs. Uh, if you see here, we have some of the private credit fund launches during 2023, wherein Kuwait, we are seeing a trend where they are launching several leasing and financing funds, while UAE and Saudi are also witnessing some traction in this space. And notably, most of the funds, the geographical focus has been North America and Europe, where the typical borrowing takes place. So, from an institutional perspective, a recent survey says that institutional investors that are managing funds more than 3 trillion, they have an average asset allocation of close to 5.7% in private credit, which in itself is a sizable number. So, some of the largest institutional investors that have exposure to private credit funds are the Canadian Pension Fund, which is CPP, CalPERS, which is the California Public Employees Retirement Fund, and CalSTRS, which is the California State Retirement Fund. Most of these funds are retirement and pension funds that have a very high allocation to private credit. And towards the right, if you see, there are a lot of GCC sovereign wealth funds that have an exposure to private credit like ADIA, Mubadala, QIA, and PIF. Even though they have exposure, the exposure is not as high as a CPP or a CalPERS. And according to a recent survey done in Europe, Middle East, and the US, there is more willingness among asset managers, wherein 75% of the respondents plan to increase their investment in private credit over the next 12 months. So we expect to see a slight bump in these numbers in 23 and 24. And finally, moving on to the regulatory side of things, the regulatory environment, as with most of the asset classes, private credit is not as tightly regulated compared to other debt instruments. So there have been concerns wherein regulators have been raising a lot of concerns related to uh, the uh, the upshoot in private credit as an asset class. And also, but if you see, there have been positive developments across different markets ranging from US, Europe, and the UK. And even in the GCC, there have been a lot of significant regulatory developments wherein ADGM and DFSA have already issued rules for private credit funds, which is also the case with Saudi Arabia, wherein they have also introduced credit fund regulations lately. So, considering these factors, if you see, for an investor, private credit is much more suitable for an institutional investor and a high net worth individual compared to a retail investor, mainly because of the transparency and regulations. But going forward, our expectation is that tightening lending standards from banks, amid expectations of moderation in economic activity, especially in 2024, and the increasing borrower preference for speed, customization, which are all offered by private credit, we expect private credit market to sustain the strong growth in the upcoming years as well. However, given the emerging nature of the asset class, at least in the retail space, lack of transparency and evolving regulatory standards are typical risks that are still there in this segment, which makes it typically suitable for institutional investors and high net worth individuals. So, but nevertheless, the need for generating alpha, which I already touched upon, is a requirement for retail investors and also institutional investors, considering the rapid movement towards passive investing. So even for asset managers, they are also focusing towards introducing a lot of alternative funds for retail investors. So with this trend also in mind, we expect retail participation also to be a bit strong in the coming years as well. So with that thought, I would like to conclude this presentation. Shankar will probably take the questions from here on.
Thank you so much, Ajay, for a very insightful presentation about private credit. While we all understand that private credit has been there in the market for a while, it has become quite popular in the last couple of years. And you did very well put across the differences between the various asset classes and bring out about how investors are becoming more curious about this asset class. On that note, we have received a couple of questions from our participants. I encourage all of them to type in their questions in the Q&A box, and we'd be very happy to answer them. Let me get started with the first question from one of our participants, Ajay. I hope it be useful for everyone when you answer it. We've seen a lot of curiosity about this asset class, private credit. Do you think this will continue in the future, especially when the interest rates are going to come down? What's your opinion about it?
Yes, even based on historical evidence, private credit as an asset class kicked off in 2020, wherein the interest rates were lower. So, in terms of there is also investor interest from the demand side, wherein uh, more institutional and retail investors need to generate this alpha. So, from the demand side, I see this as a very important factor in addition to the negative correlation with traditional equities and bonds. So these factors put together would make private credit as a very interesting asset class to have an exposure to within an investor portfolio. Typically, around 10 to 20% depending on risk appetite should go towards alternatives. And among alternatives, private credit is one of the leading asset classes wherein an investor can get exposure to.
Thank you so much, Ajay. Do you think the fund managers are also ready for handling this kind of an asset class? I know that in 2023 there was a lot of curiosity around launching private credit funds, but it's still not matching the traditional asset classes like equities or fixed income or even real estate, particularly when it comes to the Gulf region. So, what's your opinion about it?
I see, as with all alternative investments, I see asset managers taking this opportunity to popularize asset classes like private credit, especially considering the investor interest. And also, when you see the asset management industry as a whole, since there is movement towards passive investing, the margins of asset management companies have also shrink to an extent, since they're not able to generate since most of the companies are not able to generate an alpha over the index. They tend to move to these alternative investment strategies to generate alpha for the investors, and also typically increase their margins in terms of fee revenue. So I definitely expect asset managers to capitalize on this trend and continue launching similar products moving forward.
Thank you, Ajay. There's a very interesting question from one of our participants. Uh, so the question is about how do private credit funds operate when it comes to the interest rates? Do they work on a fixed interest rate basis rather than linking it to benchmark rates, or how do they work?
Typically, it's always a floating rate which is tied to a benchmark rate. So, due to this floating rate nature of private credit, they were able to outperform other fixed interest rate instruments. So, it's typically floating interest rates.
We've got a couple of more interesting questions from our participants, and I think it will keep coming as well. Um, you know, do you think illiquidity is a problem or a shortcoming for this asset class, private credit? What's your take on that?
On a relative basis, yes, but we see this improving. When you see the flows into private credit, there has been a substantial increase in the past few years. Illiquidity is definitely a risk, but I don't see that becoming a major challenge in the next few years.
Thank you, Ajay. Um, you did touch upon the regulatory aspects for private credit. What's the situation in GCC? Because we are of particular interest in the Gulf region. How is the regulatory environment evolving? Do you see some positive regulatory environment coming up? What's your
Yes,
take on
definitely. Currently, UAE and Saudi have issued a comprehensive framework for private credit, and we also see a lot of traction in markets like Kuwait and Bahrain. So, definitely, we expect other regulatory authorities to come up with new regulations and also tighten these regulations such that there is also a significant amount of investor protection, which would again lead to more traction in the market.
that? Thank you. We have a couple of more interesting questions that have come from our participants. I'm very excited that we're getting a lot of questions. And one interesting question is that which instrument is being used in the GCC as a benchmark? Like, for instance, in Asia, they use bonds rather than loans. Is there something like that in the GCC, or is it still not very popular?
As of now, it is not that popular, but typically, Fed rate would be considered a good benchmark.
Right. And going forward, uh, how do you see the number of private credit funds coming up globally and in the region? And what would be the geographical focus? Do you think the funds launched in GCC will have more geographical focus on the region itself, or will it be more outward looking?
As of now, it's more outward looking because there is already a lot of activity going on in North America and Europe. And but moving forward, as the asset class gains more popularity, there could be further traction in the Middle East. But as of now, it is primarily based out of Europe and North America.
Thank you, Ajay, and thank you, participants, for a very interactive session that you made it to be. We've answered most of the questions, and if there are any further questions, we'd be very happy to take them up. You can always reach out to us at info@e-marmot.com, and we'll be very happy to share our insights with you. Post this session, we will also share the recording of this webinar with you. Please feel free to share it with your colleagues and team members. On that note, I thank you all for joining this session. And once again, thank you, Ajay, for a very insightful presentation and very insightful webinar. Please do reach out to us in case of any business requirements. Thank you.
Thank you all.